Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Goslee. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is Your Course to Retirement with Grand Rapids Resource for that common sense approach to planning for our financial investment and retirement future, the perspective and guidance that we all need to navigate this complex financial world. Nolan Goslee, President of Cornerstone Retirement Partners, is here with us. Nolan, we appreciate the time.
Hey, happy to be back here. Happy to go over a bunch of stuff with you today and help all you folks out on the radio.
Well, Nolan, I know that in our financial lives and specifically in retirement, we've got to protect ourselves against a number of things. But I guess specifically in retirement, kind of the two biggest ones are dying too soon, not getting to enjoy our retirement, and living too long, two opposite ends of the spectrum there. How do we go about living a satisfying lifestyle with these two big risks kind of facing us and going on such opposite ends of the spectrum, kind of finding a middle ground where we can be content and satisfied with the lifestyle that we're living?
Sure. So, I mean, a lot of it just gets back to the roots of planning. These are the two biggest risks that a lot of people face in retirement. You either don't live long enough or you live way too long. And the people that don't live long enough are usually the ones that are worried about spending and worried about enjoying their retirement. And the ones that live too long are worried about their money not lasting long enough to take care of them in their later years. And so it's a wide variety of options on how to get there, but it all starts off with a plan, and specifically a plan to go over income and to talk about how you're taking money out of your accounts. And if you don't have a plan for that, then your two biggest risks are really not assessed at all.
So we need to have that plan in order to help to navigate that, to address it, to balance that. And once we've got that plan in place, Nolan, then we can really try to walk that tightrope, I guess, and balance these two risks, but not have to worry about them as much.
Sure. Yeah. And really it is about balancing risk. There are countless risks in your retirement. You really have to identify which ones are the big ones, which ones are the small ones, and how do you really want to spend your time and your efforts in addressing these risks. We think the two you mentioned are possibly the two biggest ones. We always talk about inflation risk and tax risk and things like that. There are certainly risks to your retirement, but risks to your income plan are you going to be able to use all of your money? Or are you withdrawing too heavily or not heavily enough? So yeah, all of those things need to be planned for.
Well, again, if you have questions, if you've got concerns, if you would like to get that plan put together, they offer that opportunity there at Cornerstone Retirement Partners. Nolan and the team, of course, including Ron Corser, your certified financial planner and the founder of the firm, all there helping their clients, Grand Rapids area savers and investors, with both the health and the wealth side of planning. And if you'd like their assistance, pick up the phone, give a call, 616-301-2581, 616-301-2581. At its core in that plan, especially as we're making the transition to retirement, Nolan, is our continued need for income. That's not going to stop the day after the paycheck stops and we walk away from our career.
Right. That need for income. I mean, it's something that we ensure, our entire lives, our need for income. If you're working, you almost always have to have a backup plan if you stop. Ensuring that income and making sure that your paycheck, whether you're retired or not, continues to come in is paramount to making sure that you're successful in retirement. I mean, very, very few people have enough money saved up that they don't need some of the guaranteed sources of income or don't need Social Security. So a plan and how to address the money you've saved up, how to take it out, you have to have something written down in some sort of sequence of events.
Well, to follow up on that point, we've stressed and emphasized the importance of having a plan, and then the importance of that plan addressing the need for income. Do investors without an income plan know and understand how much their portfolio will be able to produce as far as a livable income?
This is one of the questions that we do get a lot. And of course, with technology advancing, tools get better and better. And so, everybody, when you look at your 401k online, it says your estimated income in retirement, or, you retire with an IRA and you look up rules to tell you how much your portfolio would produce based on the risks you take. Well, without an income plan, without an actual plan for withdrawals, plan for taking money out of your different accounts, really you're leaving it up to guesswork. You're leaving it up to assumptions that the market's going to continue to perform the way that it has. You're leaving it up to an assumption that your 401k is correct when they tell you how much you'd be able to withdraw per month. And so working off of assumptions, I mean, it does work out, depending on who you talk to, it does work out. But a lot of times it leaves significant gaps in the planning process that definitely need to be addressed. And no, I don't think that without a written income plan, a lot of people do know where their money's going to come from. I think it's a best guess.
Well, Nolan, you've got this report that Ron has talked about previously on the program, but it is the 7 financial myths, common planning mistakes and misconceptions to reconsider. And the number one on that list of the 7 myths was that the market always goes up. We cannot depend on it always going up. It has gone up over time. And that's sort of where I think there is a blurring of the lines, which causes the misconception when people say it's always gone up over time versus it always goes up. Those are two very different statements, and your income could depend on which side of that you are falling and reliant on for your retirement.
Right. And I don't know. You never use always, never use never, like those things, I don't know. They're not even in my language at this point. Always and never, especially regarding the market, you can look at any sample that you want to and extrapolate from it.
Do you ever watch sports and notice that inevitably when the announcers say something has never happened, the next play it happens, or when they say, oh, this kicker has kicked without missing a field goal for the last 120 months or whatever, and then the very next play he misses that field goal. Whenever you say it, it's like the opposite happens.
The never happen more often than everybody think they do, right?
Right.
I never think this is going to happen, or the market always goes up. When we talk about that one, the market always going up, it doesn't. I mean, it doesn't always go up. We just got through a pandemic. We just got through like a pretty rough year where there were several months where the market was down, and there were a lot of people that were having a lot of panic about it. And so when you talk about always going up, I think that you really missed the boat here. It does go up over time, but every 5-year period is different. Every 10-year period is different. I mean, if you want to look at the most recent 10 years, wonderful 10 years in the market. I mean, the recovery out of the 2008 recession and crash was remarkable and very long lived. But if you look at the 10 years prior to that, so, the first 10 years and the most recent 20-year period, the market almost returned zero per year. I mean, it was maybe 2-3% because we had the dot-com bubble and we had the 2008 housing crisis. That 10-year period is totally different than the 10-year period we just experienced. And so if you run off of the assumption that the market always goes up, I mean, sure, it may go up over time, but every 5 to 10-year period is totally different than the last, and it requires a different type of planning depending on what type of conditions that we're in.
And number 2 myth on that list of 7 financial myths is that the market will give you a 10% rate of return, or an average 10% rate of return. I actually, even though we've had a fantastic most recent 10 to 12 years, I saw a chart recently, Nolan, that showed the compound growth of the S&P in those 2 different 10-year periods that you just described. And total over the 20-year period, it had only averaged about 4.8%, I think, even though the last 10 years has been fantastic.
Right. And, think about that if that was your retirement. Think about just retiring at the beginning of that 2000 decade. I mean, if you retired over 20 years, years and your goal was to take out a 4% rate of withdrawal and you've averaged, like you said, 4.5, well, a lot of people might say, oh, well, it worked out really well during that 20-year period, even with the bad 10 years. Well, shoot, if you were taking money out during those first 10 years, not only did you have the negative market consequences or the relatively flat market over that 10-year period, but you were also taking money out during that time. And so if your goal is to take money out of your portfolio, why would you risk it having a 100% market-based portfolio that's generating income when we have a really good 20-year period recently where they've been so different? And even if you count the whole 20 years, it may not have worked out because of poor performance in the beginning. So, how many things can you try and time at once? How many things can you try and, really leave up to guesswork?
And even if the market had been flat, if we're taking out 4% per year during that flat 10-year period that began the millennium, that's 40% of your portfolio that you've now removed that's not participating in the gains of the second 10-year period.
Exactly. And then your gains have to be even more aggressive coming up because you've had to take money out this entire time. And people usually want to get less aggressive as they go through their retirement, not more aggressive. And so one of the worst things you can do is be forced into taking more risk as your retirement goes on and leave yourself susceptible to those long-term sustained losses.
Well, if you would like to get that plan put together, your course to retirement plan, a snapshot of where you currently are, a discussion of your goals, documenting those so you know you're working to achieve them, and then recommendation from a team of experienced, qualified professionals, pick up the phone, give Cornerstone Retirement Partners a call, 616-301-2581, 616-301-2581, 616-301-2581. Circling back, Nolan, we started with these two largest risks. It seems that if number one is something that we experience, not living long enough, that is not a problem for us. That's a problem for those that may depend on us, and the income that we may have produced or the management of the assets that we may have been doing. Sure. Whereas if number two becomes a problem, we live too long, that's absolutely a problem for us. So we really do need to balance these, and the balance lies in defining the need for income and having a specific plan to fill it.
Sure. And when dealing with big risks, your easiest, I don't know, there are a lot of different ways to deal with risk. You can buy something to alleviate your risk. You can disengage from the activity to completely eliminate the risk. But, you can't disengage from retirement. I mean, you can't disengage from the risk of taking money off of your portfolio. And so a lot of times when talking to people about these risks, I mean, what do you do when you have a risk? You insure it. So when we talk about this risk of either not living long enough or living too long, one of the ways to alleviate that risk is by insuring it. The first example that you talk about where you pass too soon, you don't get to live your retirement, or you pass before you even get to retire. The most obvious form of insurance for that is life insurance, a way to insure yourself against that risk. Well, if we have an insurance for the front end, if I die too early, I mean, I have a variety of insurance on my own life. I mean, we just had a baby a few months ago. The baby already has insurance on his life, and so that insurance component is usually a part of everybody's plan. Well, the other side of that, you can also insure against the longevity risk, that risk of living too long. And a lot of times when people do that, it's through some sort of an annuity product, whether it be fixed or indexed. These are things that can produce a lifetime stream of income very similar to a pension or to your Social Security. Of course, with their own risks, but with a really good reward of giving competitive income in what I would consider an income or a yield-starved environment. It's very hard to get income right now from a lot of different places that we've traditionally used.
Those low interest rates are a problem, probably going to continue to be a problem for savers and those looking for income on a secure basis for quite some time. But there are solutions here. And Nolan, kind of circling back and forth, the 7 financial myths report that you have there at Cornerstone Retirement Partners. Number 5 on that list is, I don't need life insurance once I retire. And it sounds to me like you just gave a pretty strong reason, compelling argument why we may still indeed need or want to have as part of a complete plan some form of life insurance even after we retire. But I do see a reason why people could probably easily fool themselves into thinking or talk themselves into believing that they don't need it when they retire.
Right. And I mean, I guess it really depends on the type of insurance. Well, okay, it depends. I'm going to sound like a diaper commercial here. It depends. It depends on the risks that you've covered. It depends on what size portfolio you have. It depends on your family situation. So it depends on a variety of different things. But we see life insurance used for a couple different reasons. Number one, there are just some people that don't retire with enough money to take care of their family if they pass away. Now, that's not to say that you don't retire with money. There are plenty of people that retire with hundreds of thousands of dollars that still need life insurance, either because they're very young when they retire, or they have young kids when they retire, or their spouse isn't going to have their the deceased spouse's Social Security and pension. And so life insurance can sometimes be an income gap for a spouse that you leave behind. So that's one of the reasons that we use it, is just to cover that income need for the surviving spouse should anything happen to you. On the flip side of that, long-term life insurance is used for a variety of different reasons, but one of the key ones is long-term care planning. A lot of people will say, well, I don't necessarily need the life insurance to cover my family. I have a portfolio that takes care of my debts if I pass away, and my family does well enough that they don't need the income. Well, that's okay. But one of the other considerations, and one of the most costly considerations in retirement, is long-term care. And a lot of times with appropriate life insurance planning, we can address a lot of long-term care concerns within the life insurance realm. So if you're worried about, maybe my pile of life insurance money or my pile of bank money isn't going to cover any long-term care, $6,000, $7,000, $8,000 per month sometimes. There are some life insurance policies you can purchase where you can actually tap into the death benefit to pay for some of those expenses while you're living, which is a really, really cool thing. So life insurance, I think, gets kind of a weird connotation because a lot of people just think about it term insurance, whole life insurance, temporary versus permanent. While they are divided up like that, they do have a wide variety of uses in retirement, and it's not always income replacement, but a lot of times it is.
Well, I think that is a very attractive newer feature of certain types of life insurance. The fact that we can advance that money to ourselves for those care expenses, because I know that the fear of the need for care is there, but I think that the big fear is, how am I going to pay for the care if I do need it? And it's not always a fear for my own situation. My fear in my marriage, if I required care and we'd have to figure out how to pay for it, is that my wife would be providing that care and then I'd leave her with next to nothing after I'm gone. And I think that feature of the modern types of life insurance, allowing you to advance that death benefit
Right.
to cover those costs, would be very reassuring. And further than that, Nolan, what if I don't need care? I still want to live a fulfilled lifestyle with me and my wife being able to spend comfortably. And I'm not sure how comfortable I would be seeing the pile of money kind of deplete and dwindle away, regardless of our health status or not.
For sure. And I mean, that's, I guess, the nice thing about just addressing that or talking about the income needs, because, let's say you don't need the long-term care. Well, you're still taking, a sum of money and buying life insurance. And when you take a sum of money and buy life insurance, the death benefit's almost always significantly higher than the amount of money that you put into it. And so even if you don't need the long-term care, it can still be part of the estate planning. It could still be part of the passing assets on to, either a spouse or the next generation in a more tax efficient manner as well. So yeah, there are a lot of benefits, certainly some cons associated with it, but as long as you understand, I think, what you're purchasing and what you're getting into and why you're getting into it. I mean, understanding the purpose of the insurance. And that's really what we're talking about here. Understanding the purpose of the insurance. Why do I have it? What is it doing for me? We're talking about long-term care hybrid insurance right now. The need arose, like you said, they're newer policies. The need arose because companies just stopped offering a bunch of long-term care insurance. It wasn't cost effective for them.
Which tells me that this is a problem not only for them, not having a profitable product, they wouldn't have quit offering it if they did. But that means it's even more of a problem for us as individuals than most people realize, because if the insurance industry walked away from this because too many people needed it, it was too expensive, people needed it for longer than they thought, and the care cost more, that means that that's a big potential risk for me as an individual that I do probably need to address in order to be confident throughout retirement.
Right. Yeah. Everybody wants everybody wants it all, right? You want to be able to use a lot of your money when you first retire so that you can enjoy yourself. And then you want more of your money to be there long-term so that you don't outlive it. And then you want a little more money towards the end so that you can pay for the more expensive end of life things. And so I think when we talk about these desires, these retirement goals, these wants and needs, you have to have a plan for all of them. You have to know where your money's going to go when you leave it behind. You have to know how your wife is going to be impacted by, you passing away, or if you do enter long-term care, what provisions are in place for her to protect her, and a wide variety of plans. So yeah, there are a lot of things that go into it for sure. The insurance side of retirement is extremely complicated, and there are many facets of it.
And yet, I think this is a topic that people don't want to have to think about day to day, don't want to have to constantly worry about throughout retirement. But that's why the planning process is so important. And if properly constructed, we can include the protection against catastrophic costs or income replacement into the base income plan for that confident, stable retirement income.
Right. And how nice and how reassuring and how easily would you sleep at night, if you could say, well, I have my income for the next 5 years. I have my income for years 20 plus. I have my income for all the years in between, and I know where it's all going to come from. And so, there's 100 different ways to do it, 1,000 different ways to do it, but coming up with a plan and actually getting that plan in writing it's the first step. It's not just, I'm going to do 60% stocks, 40% bonds. It's a little more than that.
And circling back again, Nolan, that is why myth number 6 on your list here, common misconception, I can just rely on my investment plan for retirement, is something that we really need to examine and reconsider, because that stable, predictable, confident retirement that we can rely on can't always be generated from a market-based investment portfolio.
Right. And when you have a market-based investment portfolio and your assumption is that you can rely on this investment portfolio for your retirement, assumptions are only as good as the market turns out to be. I can create the most beautiful portfolio that anybody's ever seen and provide you with 1 year's worth of back data, because I can just choose whatever I want and put it in the portfolio and just show you how it's done over the past year. I mean, shoot, you could do that with so many different stocks right now that you can build one of the most beautiful looking portfolios ever. But if next year isn't like this most recent year was, all of those stocks probably aren't going to do the same thing. And so when you're trying to rely on an investment portfolio and all the money that you've diligently saved up and all of your employer matches and all the compounding interest, if your plan is just to take this and then slap it in the market and hope that you have a good first 3 to 5 years, and then the remaining 5 to 30 are relatively okay. I mean, that's a big basket to put all of your eggs in, for sure. And it does impact people negatively when you do something like that.
Well, Nolan, I know that you and your team there at Cornerstone Retirement Partners, you deal with some savers and investors who have done very well for themselves, and they're looking to leverage and identify as many opportunities as possible, and fantastic for them. And kudos to the job that you and your team at Cornerstone do for those individuals. But you also work with folks maybe in a little bit of a different category here. And I want to round out our maybe conversation about these 7 financial myths. Number 7 is that it's too late to plan, or I don't have enough. And through income planning, we can sometimes do more with less, and we can probably help to address these two sides of this greatest risk in retirement of the question of how long do we need what we have to last for?
Yeah. Yeah, and it's too late to plan. I don't have enough. I don't know where to go. I don't know what to do. Like these are things that they don't have a coach for you for. I mean, think about when you worked. You have an HR department that says, well, you should save this much per year. You had a 401k provider that would come in and estimate what your performance would be and help you with your allocations. And a lot of people get to this final hurdle at age 60 or age 65 or age 67 or 70 or whatever. And they say, I haven't done any planning. The only thing I've done is just saved and saved and saved, and I don't know what to do at this point. And so a lot of people, it's that hurdle. It's just really understanding what you do have. How much do you have in your employer-sponsored plans? How much do you have in that pension from an employer 15 years ago? How much do you have in Social Security? And when is the best claiming age, based on when your portfolio is maturing or when your pension kicks on? So it's never an I don't have enough and it's too late to plan. I mean, it's never too late to plan. Tomorrow is the perfect day to start planning. Today is the perfect day to start planning. Tomorrow is one day later. So if you want to plan and if you want to have some sort of certainty built into your portfolio that I know I'm going to do well and I know where my income's coming from for the next 5 years. I mean, that's what the plan is. And it's never too late to start that plan. I mean, we start that plan with 20-year-olds, we start that plan with 75-year-olds and everything in between, $5,000, $500,000. Really, there is no bad time to start. Your plan might be, well, I got to keep working for a little longer than I want to, and that's okay. That's some people's plan. You're still going to get a 20+ year retirement probably. So, it's just coming to the realization that, you may have not done a significant amount of planning up until now, but there's never a better time to start.
Well, if you want a little shade in your yard or to hang a hammock or something, the best time to have planted a tree would have been 10 or 15 years ago. But if you didn't, the best time is today. Procrastination is nobody's friend in achieving our long-term goals. And that's why the team from Cornerstone Retirement Partners is here as your resource, ladies and gentlemen. And we talked about a couple of different things. One, if you would like your individual course to retirement plan mapped out by a team of experienced professionals, that's what they are here for. The value of being tuned into the program right now is that you can get a specific customized plan, your course to retirement plan, that snapshot of where you are, the discussion of your goals and recommendations, timeline of executable action items on what you should do to achieve those goals, turn those dreams into reality into the future. To get that course to retirement plan, pick up the phone, give a call, 616-301-2581, 616-301-2581. We also talked on this segment of the program about the 7 myths report that we have covered in previous editions of the program. But if you would like to just get this report, they do make that available as well. And we touched on several of them, but we did not talk about a few of risks, taxes, and cash flow in retirement. All 3 of those are pretty important as well. So if you'd like this complete list of the 7 financial myths, give them a call at that same number or go online, cornerstone-rp.com, cornerstone-rp.com, or give a call, request the 7 financial myths report, 616-301-2581. Quick break. We'll come back. We'll talk with more with Nolan Goslee about these big risks in retirement and how to plan to address them. What topics do you need to tackle in your course to retirement plan? In just a moment when we come back.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Goslee. Cornerstone Retirement Partners are planning today for the potential of tomorrow. Visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
And welcome back to the program. This is Your Course to Retirement. Pleasure today to be joined by Nolan Goslee, president of Cornerstone Retirement Partners. If you've got questions about your course to retirement, if you'd like to get that plan put together, pick up the phone, give them a call, 616-301-2581, 616-301-2581. Nolan, as we are talking about balancing these risks in retirement, how to have confidence in our plan and not be worried day to day about going too soon or living too long, neither of which we want to be fearful of as we are living our life. There are several factors that do need to be addressed. Income is a priority, and determining that cash flow or withdrawal rate is a big part of that process.
Sure. Yeah. The cash flow, the withdrawal rate, is something that's probably the most pivotal thing that you can possibly do when doing income planning. Your cash flow rate, or how much you actually need to generate off of your portfolio, is basically like a key. A key to a map. It's like having a compass. If you know how much money you need to take out of your portfolio, you can work back from there. If you have, X dollar amount need per year, you can get so many dollars from Social Security, so many dollars from your pension. You have to get X dollars from your portfolio, and then that gives you what your portfolio actually needs to generate in cash flow. When working, it's a little bit easier. Your cash flow is basically just coming from one place. When you retire, when you have 1, 2, 3 different places, and they're all taxed differently and they're all treated differently by the IRS, it gets a little bit more complicated.
Indeed. In the first segment of the program, we talked about life insurance and why life insurance may still be important or critical for some situations in retirement, most of all being if we pass away too soon. But secondly, if we do live a long time, replenishing the lump sum, giving others the ability to continue living with confidence, or even being able to advance ourselves some money to protect loved ones against the costs of our own care if we require it. On the other end of that spectrum, we don't want to run out of money. So income and income protection is another kind of insurance that we can actually place on our retirement. And I'm not sure a lot of people realize that they can actually insure their income throughout retirement, that they won't run out.
Yeah, a lot of people are not too familiar with that concept. When we're talking about guaranteeing income, guarantee associates with some sort of pledge on your money. Now, when we talk about guarantees and we talk about guarantees in income planning, we're simply talking about annuities in most cases. Now, there are a wide variety of annuities. We don't deal with variable ones all that much, and so I'll probably skip the majority of that for today's conversation and keep it relatively simple. But when we're talking about using annuities for income planning, we like to use ones that can guarantee some sort of income. So you retire with X dollars, you know that, if you were to fund an annuity with some of that money, you can get this much income every single year. And using that as a portion of the income is usually a good idea because it's a reliable stream of income that's not subject to market risk and volatility and has some pledge with a North American insurance company that they will guarantee that payment. And North American insurance companies, I don't know if everybody knows this, but they're pretty financially stable. Insurance companies know how to operate their cash flow and how to, keep good money on hand.
Now, if we wanted to designate a portion of our portfolio, our retirement funds to protecting our income and providing that protection, does that then take ongoing investment management day to day, watching the market, worrying if something is going to alter or change that plan or impact it negatively?
Yeah, so that's one of the nice things about working in the insurance field, alongside the investments. So, I mean, investments have their own set of risks. So does insurance. But when you put money into something like a fixed annuity or like a fixed indexed annuity or even cash value life insurance, you take the market risk away from that portion of the portfolio. And so if you say, okay, well, I'm going to designate 30% of my retirement savings into insurances for a variety of reasons, but the main one being income. Well, the nice thing is you're now taking that 30% of your portfolio and saying, okay, that's 30% of my portfolio. I'm not going to have to buy and sell stocks with. I'm not going to have actively managed. Most times you can knock off any fees that are associated with a product or something like that. And so it really just kind of alleviates a lot of the stressors that are having retirees sweat a little bit on an ongoing basis. You don't have to worry about the S&P 500 or the Dow Jones Industrial Average all that much. You don't have to worry about what's going on MSNBC's ticker tape on the bottom of the screen or whatever. You start to alleviate some of those risks and those stressors. And that's really what retirement's all about, is relieving that stress and trying to implement something that's reliable, systematic, and doesn't have that many risks associated with it.
So, Nolan, by having that income planning component of our course to retirement plan, if I heard you correctly, we can lower fees on the total portfolio. We can lower risk to the total portfolio. Oftentimes, we can increase the income or at least protect the income that we are generating.
For sure. Yeah. All three of those things are kind of synonymous with working within fixed or fixed indexed annuities, specifically for income. These tools do take off a whole lot of those risks. And if you're coming from a completely market-based portfolio, it's a nice relief to have, to be able to look at, okay, here's my aggregate portfolio, but only 70% of it or 60% or whatever is exposed to the market. So that means that if everything crashes like it kind of did in the beginning of 2020 due to a pandemic or due to any unforeseen circumstance, you're now not having to get back over as much of a hurdle to recover all your money because not all of it went down when the market crashed. So you're addressing risks on multiple levels and scratching the surface of a lot of different risk mitigation when talking about insurance planning and talking about alleviating some of those risks. Yep.
Well, we've even talked with Ron, your business partner there at Cornerstone Retirement Partners, before about how this question of longevity is actually the biggest risk because it multiplies all of those other ancillary risks. And I think that's what you're touching on here, is that this helps to mitigate or at least address several of those other risks when we've got this portion, this core of our plan in place. Maybe several of those other risks, market risk and inflation and taxation and low interest rates, won't be as much of a concern because we've addressed that with the core income plan.
Right. And that's really the difference between income planning and asset allocation. Like, it really didn't matter. Well, it did, but it didn't really matter what inflation was during the 90s or 2000s. It didn't really matter what interest rates were during the 90s and 2000s. It didn't really matter what any of those things were when you were starting your retirement savings. Okay. You had tax deferral, you had compound growth in your IRAs, you had well-blended portfolios that went through a variety of different interest rate environments and economic cycles and everything like that. And so
you're speaking to people who were earning a paycheck during
correct,
that time
yeah,
that
yeah,
they could rely on.
Yeah, you're working and you have that income, and shoot, if you lost your job, well, maybe a couple months until you find a new job, but then you still have that income. And what happens within your portfolio during those times, it does matter, but not as much, in reality. Whereas if you're retired and you no longer have that income and you don't plan on going and getting another job 2-3 months from now, if your portfolio crashes 40 or 50%, you shouldn't really be exposing yourself to those types of risks. If you're not capable of being, the mainstay within your retirement income at that point by getting another job or finding another income stream, you shouldn't really have 100% of your portfolio exposed to those risks anyway. Just like you said, you run the risk of outliving your money, and that risk exacerbates all other risks within your portfolio.
Right. And as long as we were earning that paycheck and then making regular contributions to our retirement accounts during those periods of time, the dot-com bubble, 2000 to 2002, 2007 to 2008, the Great Recession, we hate to see the market go down, and we definitely hate to hear all of the fear mongering on the news when those times come. They make it seem like it's the end of the world. But so long as we had a paycheck to cover our expenses, to pay our bills, to pay the taxes, and to buy the things that we need, as long as we had those things, those times were actually an inherent advantage to our long-term savings. But when we turn the corner to retirement, that's a completely different story, isn't it?
Right. And, the story changes really just because, we have so many different things that we need to adjust to. There's now, the hurdle of figuring out how many taxes you're going to have to pay each year with your different income sources. How is your Social Security income going to be impacted if you pick up another part-time job? What if the market goes down 20, 30%? Are you capable of not taking money out of your portfolio for a year or two while you recover? And so, there's a lot of risks, a lot of uncertainty. And that's certainly something that needs to be addressed as you make the transition into retirement and the years prior to making that transition too. I mean, I feel that the people that are usually the best prepared are the ones that really start taking their income planning seriously within 10 years of when they actually want to retire. It gives you a nice window of saying, well, here's the money I have so far. Here's how I plan on continuing to save. And then here's how much I expect to have at the end of the road. But again, that's working off of assumptions. You never know how much you're going to earn over the next 5 to 10 years. And so that planning and the income planning becomes even more important the closer you get to that retirement date.
And your outcome only as good as the assumptions that your planning is based on.
Right.
Nolan, one of the big assumptions that planners have been making for decades is that taxes will be lower in retirement. I know that right now there's a lot of talk, there's a lot of concern that taxes could be heading the other direction. The tax rates, tax brackets could be heading in a less favorable direction into the future. Does that make it even more of a priority to be proactive and to do some planning in advance for generating that retirement income? Does that make it that much more important if we believe that may be a risk?
Yeah, well, we certainly think so. We started in 2017, we started doing seminars for tax planning in retirement. And so we started doing this type of stuff 3-4 years ago, really recognizing that there were some regulations that were coming through. And then especially at the tail end of the tail end of 2019, when they changed how IRA payouts have to work. And, then you had the Tax Cuts and Jobs Act of 2017 that really already had tax hikes built into it. A lot of people don't know that, but tax rates were already scheduled to increase over time for the next 3, 4, 5 years. Compound that with, we have so much stimulus money that's been issued and so much new government debt and everything like that. Well, certainly, I mean, it's becoming incredibly important to prepare for sure. The taxes are going to be a nightmare coming up, to put it lightly. Where's the money going to come from?
Yeah. Well, if you have those concerns, if you would like to plan proactively to keep as much of your money as possible, and I will say this, that if you are saving for your financial future currently in a retirement account, or you already have a large balance built up, particularly in tax deferred retirement accounts, you need to be paying attention right now, because this is your opportunity. We can sort of buy taxes while they are on sale today, or at least at known rates, and you can be proactive. There's strategies for almost every saver and investor, regardless of your income or net worth, to be more tax efficient with your money. And the team from Cornerstone Retirement Partners can help you identify those strategies and take advantage of them. Pick up the phone and give a call. That is also part of the planning process. It is part of your course to retirement, the plan that they will put together for you. And the value of tuning in right now is that you can get that plan, no cost, no obligation. Pick up the phone, give a call, 616-301-2581, 616-301-2581, 616-301-2581. Nolan, you mentioned briefly a little bit about Social Security and how that was kind of an important part of the retirement income planning process, and that picture. There at Cornerstone Retirement Partners, that is another part of the course to retirement plan that you put together, helping people understand those options, be educated, and then trying to help them optimize their decisions on when, how to claim and collect Social Security, and how much they're ultimately going to get from that over their lifetimes.
Yeah, for sure. When doing taxes, in retirement planning and, tax projections and things like that. I mean, one of the things that we always look for is, where is your money? Well, if you look at Social Security kind of like a bucket of money, you're going to take out X dollars for 20 or 30 years. I mean, for a lot of people, it's hundreds of thousands of dollars. And it's really important to know how you're going to take that money out of that system. Now, whether that be you're going to take Social Security out early and maximize your returns because you don't know when the Lord's going to call you home, or you want to continue working and delay Social Security for as long as you can and draw it at 70, or anything in between. Number one, it's important to have a plan for when you're going to draw it. And so what we like to do is during our discovery meeting or during our first meeting, Social Security always comes up. We ask you, do you have long-term care? Do you know how much your Social Security is? Do you have a plan for when you're going to draw it? And if so, how much are you going to get? That coincides very well with kind of the tax planning in income planning. So based on Social Security, based on pensions, is it tax beneficial for you to have a large majority of your money in traditional IRAs? Should you consider Roth IRAs? How is your money going to be taxed on a year-to-year basis from your Social Security? All of those things go into the retirement plan, and we do Social Security analyses for basically everybody that we bring into the office at this point. I mean, you have to know what your claiming options are. Now, with the act that came through in 2015, changed the way a lot of the Social Security claiming strategies were available. I mean, you used to have
Protecting Social Security Opportunity Act.
Right.
The Bipartisan Budget, basically.
Bipartisan Budget Act,
of
2015, right?
Yep.
So it was kind of tucked in there where they took some of the claiming strategies away. But there are still options as far as how to maybe leverage that system a little bit better. Hybrid claiming strategies where one spouse claims early, one claims later. A variety of options are still out there. And that's something that we go through with everybody at this point. So yeah, it's really important to understand how that claiming strategy is going to impact you long-term and how it's going to affect your portfolio draw.
Well, we are talking with Nolan Goslee today about making sure that we know our money is going to last. About what if I live a long time? What if I live too long in retirement? We don't want that to be a concern. We don't want that to be a risk. And we touched on taxes. We touched on Social Security. Those two items alone, through careful planning, how much you pay in taxes, probably one of your largest known expenses in retirement, and being strategic and efficient with that versus defaulting to the government's IRS plan for how to take that money back, confiscate it. I mean, really, there's no other word for it. How to harvest those tax dollars out of your retirement accounts. The difference in being proactive can mean several hundreds of thousands of dollars over the course of your lifetime. Social Security, a poor decision on when and how to claim and collect, a poor timing of that versus an optimal timing of that can be several hundreds of thousands of dollars over the course of your retirement. Those are two things well worth the time to get educated on. Certainly will help us address this risk of what if I don't have enough money to last, Nolan?
Right. And, Social Security and IRA withdrawal planning, I mean, these are things that you get help with at least a little bit during your entire working career. So why wouldn't you want to get help with them post work? Like you need to know how to claim Social Security. The Social Security Administration doesn't give you tips and tricks. They tell you what your claiming options are right now, and then say, what would you like to do?
Yeah, their job is not to give you recommendations on if it's the best day to show up and claim. They file the paperwork the day you show up.
They're there to show you a set of tires, and it's not their job to tell you which density of rubber is best for you. So, they're simply to show you the way things are. Same situation with your 401k, your 403b, your 457. You had advice on how much to put in. You had advice, at least initially, on how to allocate that money. Why wouldn't you want advice on it once you need to start taking money out? It could be argued 100 million times that taking money out of your portfolio is more important than putting money into it. And especially knowing how your money is going to be affected when you take money out. And I mean, you got to have a plan. You have to know.
Not what you put in, it's what you get to take out. It's not what you have, it's what you get to keep.
It's your take home. It's your take home. Yeah, you have to know your net take home. How much money is actually going to hit the mailbox every single month.
Well, we are talking with Nolan Goslee. And again, if you would like your course to retirement pick up the phone, give Cornerstone Retirement Partners a call, 616-301-2581, 616-301-2581. Go online, cornerstone-rp.com. Grand Rapids, your resource for the common sense approach to planning. Nolan, we recently talked about this Kiplinger article. You are not ready to retire until you can answer these 7 questions. It was kind of a fun article, but raised some good points. Number 1, how much more do I have left in the tank? And when I originally read this article, I thought that was talking about our bucket of money. How much do I have in assets? This is actually talking about more of the mental and emotional side of that working career, and how, especially with the pandemic, a lot of people are realizing that the quality of life would be better, and they're looking to try to retire maybe even a little sooner than they once thought.
Yeah. And I think the past year has really shown us, what life can be like if we're not so tethered to work, if we're not so tethered to the office. And then retirement not only becomes more feasible, but becomes exciting for some people. And it's that excitement that really inspires us to start the conversation. But it's what you said, it's that emotional well-being, it's the mental toughness, it's the ability to understand that it's a huge emotional trauma going into retirement. I mean, you've spent your entire life saving, accumulating, growing, saving. And now you have to kind of figure out how to take money out of your portfolio. Well, yeah, of course it's financial strain, but it's a completely different mentality psychologically. You're no longer contributing. You have to start taking money out. And in bad years, when your money goes down, all of a sudden these bad years, you're a lot more sensitive to them, and you feel these losses a lot more. And so, yeah, it's the emotional component to it. It's you want to make sure that you're in the right mental state, that you're doing the right thing for your family, that your family feels comfortable with what you're doing too, that your spouse is involved in your decision-making process. And so these are all things that become new,
Number 2 in this list. I'm curious, if you have to have these conversations, Nolan, what will I do in retirement? Do you ever run up with conversations with any savers or investors that say, yeah, I think I'm ready financially, but what I'm going to do with my time, I have no idea?
A lot more often than you'd think. And I think that it comes at times like these. I think there were a lot of people that retired early in 2007, 2008. Maybe their portfolios didn't go down quite as much and they were near retirement anyway. And it's kind of the same thing right now, where you're coming off of like a good recovery year, and now you have a little bit more money than you did before. And now you can seriously contemplate retirement. Not knowing what to do, the world's your oyster. There are a lot of people that come to me and say, well, I do want to retire, but I don't need my money. And what a wonderful problem to have. Say my Social Security and my small pension and my wife's Social Security can cover all of our bills. So that's a really, really nice thing. But you still have to stay occupied. We all hear about the people that work and work and work their entire lives and then stop one day and then they're dead within a year. And that happens. It's figuring out how to enjoy that retirement. And that's part of the plan. It's not just you're going to take out $60,000 per year. It's you're going to take out $60,000 per year, and I'm going to hold you to it if you say you want to go on a cruise every spring, or you want to go to your vacation and do 1 month in Florida in January because Michigan winters are getting too rough, or whatever that might be. But coming up with activities to substitute what you used to do and you used to work, and maybe part of that is part-time work. Who knows? But coming up with a plan of what you actually want to do, that's part of the process too. It's not just flip the switch and then you assume you're going to be okay. And I think not everybody is.
Now, and I think that maybe retirement's not for everyone. And saying that's a little funny, but there are some folks that are very driven to continue some kind of career. That's their social circle. That's what they find personally rewarding and fulfilling. Mm-hmm. But at the same time, I think a lot of people are finding that they want to do more of what they want to do and less of what they have to do. And so maybe some kind of transition is appropriate there. And we still need to plan for that. You touched on, I was going to say, Nolan, that the rest of these questions are everything that we answered and addressed today with the exception of one, but you actually just hit on the one that was the exception. Number 6, where will I live? This is something that we've got to think through as we are making that transition to retirement. Maybe winters are getting a little tough for us up here.
Yeah, I have, being in Michigan, it's an interesting state. There are a lot of benefits as far as taxation for different plans and stuff like that a lot of people utilize, but there are some drawbacks. So where will I live in retirement? I mean, that's a question that a lot of people here ask. If I do plan on splitting my residences, is it more beneficial to have my permanent residence in one state versus another? Do I get a state tax benefit by living in one state permanently and having a vacation home in another? Or, if I'm planning on doing some college funding for grandkids, while I'm living somewhere else, are there some states that might give better tax benefits for plans like those? So where you'll live is very important. Now, let's say you Michiganders here just want to stay in Michigan. Just because you want to stay here doesn't mean that your house is the appropriate place to stay long term. Depending on the upgrades that you've done over the past 20, 30 years, paying down the debt on that house, you might not be able to stay mobile long term in there. So where will I live? If it's the house you live in, how much are you going to have to do to renovate to make it so you can live there? If it's not the house that you live in and you plan on doing some sort of retirement community, what's the plan there? And where will you live is an evolving question. I mean, that changes too. It's not the same right now as it will be in 10 years, because who knows who's going to be with you 10 years from now. You could have kids and grandkids living with you. You could have, one less spouse, unfortunately, God forbid it. And so just having a plan where you're going to live, where's the roof over your head going to come from? It's very important.
Well, once all of those things are sort of discussed and decided, that's when the planning process goes into full steam, and that course to retirement plan that you can get just for being a listener to this program. That's why you want to have these conversations and be proactive, is so you can sort of think through some of these things that are going to determine how that plan should be structured. Do you want to add additional protections for income so that you can have some confidence in your income producing ability for as long as you may live? Do you want to add certain protections for your family, for your loved ones, and in case you don't live a great deal of time into and throughout retirement? Deciding those things, having those discussions, that's what Nolan Goslee, Ron Corser, and the team there at Cornerstone Retirement Partners are willing to do with you and for you, and get you that course to retirement plan. All you need to do is pick up the phone, give a call, 616-301-2581, 616-301-2581. Visit online, cornerstone-rp.com, cornerstone-rp.com. And the rest of these 7 questions that you are not ready to retire until you can answer from this Kiplinger article, Nolan, I think are all the items that the plan specifically addresses. Do I have enough to create the cash flow I need? How will I pay for healthcare expenses? Do I understand the liabilities I will have in retirement, and how I can address those? And am I maximizing Social Security? All part of that plan that we talked about can help us to walk that tightrope and that delicate balance of enough income in retirement and a confident lifestyle.
Yeah. And do I have enough is the big question. You and your neighbor could have the exact same sum of money, but just because you have the exact same sum of money does not mean that you both have enough. Your situation could be totally different than theirs, and there is no one size fits all answer as far as, do I have enough? Now, do I have enough? I don't know, but we can usually find out. We can usually give you a certain degree of certainty that portions of your portfolio will be able to provide X for you. We'll be able to provide income for you. We'll be able to provide growth for you. And so it's really delineating what is really important for each pile of my money, and how am I best going to secure my next 10 or 15 years based on what I have today. So do I have enough? I don't know, but we can certainly try and help you find out.
That's what the planning process truly helps you to determine, and why having your game plan for retirement, your course to retirement mapped out in that plan is so valuable. The opportunity is here for you, ladies and gentlemen. Pick up the phone, give Cornerstone Retirement Partners a call, 616-301-2581, 616-301-2581. Nolan, we always appreciate your time and are glad that you are a resource to Michiganders and those in and around Grand Rapids, those taking their planning and their financial future seriously.
Yeah, thanks so much for having me, and I'll see everybody next month.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.